drive-thru review. Just a little bit of housekeeping. The audience is on mute. You can ask your questions in the box on the right of the screen. Just type your message and we'll see it and answer it at the end of the session. A recording of this drive-thru review will be available on our website tomorrow for those who couldn't be here. So make sure to tell all your friends about all the great insight you heard here today. As usual, your hosts are Jess Helms, our Managing Director, Chris Drawn, our Director of Financial Planning, and myself, Ashley Sheridan. Today we want to cover what happened last year, economically, in politics, and in your portfolios, what our outlook is for the coming year in those same areas, and lastly, Chris is going to share some thoughts on planning tips and themes to best navigate through this next year. The three big topics we want to cover for 2013 include the economic highlights and lowlights, what the Fed did in their monetary policy, as well as what happened in the political landscape for 2013. Now let's start with the good news. In manufacturing, the index is over 56, and anything that's over 50 signifies growth, and it's been better than expected growth. Great sign. In energy, the U.S. Energy Information Administration had released its 2014 Energy Outlook last month, and they said a lot of what we've been saying for a while now. The U.S. is producing much more oil than we had been, and it's continuing to reshape the U.S.'s energy outlook. The historical high in crude oil production in the U.S. was back in 1970 when we were producing about 9.6 million barrels a day, and we're actually getting very close to that once again. The low natural gas prices are also boosting the natural gas intensive industries. So the U.S. is importing much less than we used to be. We went from 30% of our consumption back in 2005 to 16% in 2012, and it should be about 4% by 2040 according to the same outlook.
This is Jeff. I just add a couple of comments on the economic highlights. There's so much complex data when it comes to evaluating the economy. I try to boil it down to really three questions. The questions are we growing? Are we spending? And are we hiring? If we're growing and people are spending money and people are hiring people, that's really what drives economic growth. And in terms of growth, we just got the third quarter numbers for gross domestic product. For those of you who might not be familiar with GDP, it's the value of all goods and services produced domestically in a year. The fourth quarter numbers were revised to 4.1% annualized. That was on top of second quarter numbers. So the third quarter was 4.1. The second quarter of last year was 2.5. So depending on where fourth quarter numbers come in, and they should look pretty good, you're probably looking at overall economic growth last year of somewhere around 3 to 3.2%, which is good but not great. We've said it before. This is a plow horse economy. This is not a technologically driven growth cycle. It's a plow horse driven cycle, and we're seeing that in manufacturing and energy primarily. So we are seeing growth across the board. It's tepid in some areas and better in others, particularly in housing. But it's got a very strong base. So we think from a highlights perspective, that's all good news. In terms of spending, the consumer continues to be resilient. Consumer spending makes up about 70% of GDP, and so consumer spending has continued to be robust, and that along with housing and energy have been large contributors, along with manufacturing, but have been large contributors to this. And what all that tells you is that the economy is firing on more engines now, or more cylinders now than it has in the past, which is good news. In terms of lowlights, really the one that stands out the most is obviously unemployment. Ashley, I don't know if you have any comments on that or not.
Yes, I do. Unemployment went from 7.9% back in January of last year to 6.7% in December, which is a good sign because it's headed in the right direction, but we're still far from the low that we saw in 2007 when it was under 5%.
Yeah, so, and unemployment will likely continue to be stubborn. We'll talk about how that affects, monetary policy in a moment or two. But, there are a lot of things, we were talking about this morning, there are a lot of things that have been kind of taken out of the equation going forward that give us all, a fairly positive outlook. And having gone through 2008 and 2009, where we all experienced painfully what we would refer to as event risk. And event risk refers to when you wake up one morning and an event has occurred that no one anticipated, either the depth or the severity of it. And so through a combination of legislation and circuit breakers in the economy and the markets, a lot of that potential for an event risk like we experienced in '08 have kind of been taken out of the equation. And what that means is it doesn't mean that we won't have contractions. It just means that we won't be blindsided by them as much as we have in the past. And so with that, we'll talk a little bit more about monetary policy. For those of you who have attended any of my workshops in the past, you know that I have the 10 laws of investing. And the first one is the short-term direction of things is fundamentally unknowable. And this was proven out when the Fed officially announced that they were going to begin tapering, which means essentially that the Fed was going to stop flooding so much liquidity into the market. You'll recall back in June and July of last year when Bernanke first hinted at this, the equity markets threw up on themselves for about 3 weeks. And it was a pretty painful time, just because they talked about the prospect of tapering. Well, lo and behold, when the Fed came out and announced they were officially going to start tapering, the market went up 300 points that day. And once again, just proving the point that nobody knows anything in the short run. And what we would submit is that the market has priced in that expectation of tapering going forward, and that would be evidence of that. So on top of that, there's a new sheriff in town. Janet Yellen is the new Fed chair. If you follow this stuff in the paper, you already know that she's very dovish when it comes to the tapering issue. That means that she'll probably be less likely to taper quickly than Bernanke would. Less concerned about inflation. The latest inflation numbers show that inflation is running at about 1.5%. Make no mistake, when you print money like the government's been printing money, sooner or later inflation will come back to haunt you. But the question, of course, is when. But we would expect the tapering to continue throughout 2014, with the Fed announcing the amount of the tapers based on their measurement of economic data. If the economy continues to support itself, then we would expect to see tapering become a little bit more aggressive. We would certainly hope that it would, because there's differing opinions on this, but generally speaking, there are a lot of folks out there, and pretty learned folks, that do not believe that quantitative easing helps. Economies fix themselves. We've said that over and over again, and so we think that's the case here. So hopefully the market has priced in the expectation that the Fed is going to kind of pull back here and let the economy work on its own. In terms of the political landscape, it remains dysfunction junction. Things have improved a little bit on the political front in Washington. We saw a bipartisan bill passed. Yay. It's nice to have one under your belt. It'd be nice to see them pass a few more. But there are a couple of wild cards in 2014 as far as politics are concerned. And to a degree, they could be, potential derailers. One is the current administration's continued insistence of, essentially a veiled threat to use executive powers to pass legislation. And that works counter to getting the House and the Senate to work together. And that certainly could be one thing. The other thing that we see on the political horizon that could be a difficulty this year is the 2014 elections. We all know that the ¡1 job in Washington these days is to get reelected. And so between now and November, you'll be hearing a lot about that, and you know, that could be a potential disruptor. It also could be something that ends up helping Congress come together and work more effectively. So that we're just going to have to wait and see on.
Yeah, my point there is that unlike the prior election cycles coming out of 2008, the economy domestically here in the U.S., and for many people, their wallets are doing much better today than they have in the past. And so the rhetoric that was used to end the politicking of the election seasons, I don't think will be as persuasive this time around, in that most people are in better financial shape today than they were before. So it'll be an interesting cycle, and I wouldn't be surprised if we end up with some lame duck elections having taken place and not much of anything really changing, good or bad, by the end of the year.
Thank you, Chris. Well, with that, you know, we've committed in these webinars to keep them brief, to keep them to 30 minutes, and try to highlight the things we think are important about the recent past, the things most importantly you need to look for going forward. So with that, let's kind of look at a market recap for the year. We will refrain from using charts and graphs in future webinars because I'm not sure they're that effective. This is one, however, we all believe in. And we'll continue to use this to try to help people understand not only returns, but actually understand how markets work and why diversification is so important. What you're looking at here is a chart that's color-coded by different kinds of assets that you can own. So if you were to look up here at the top, right here, you'd see real estate, okay? And in 2004, real estate was the top performing asset, okay? Emerging markets was the second best asset. The Dow Jones Commodity Index down here was up 9.1 for the year, and so on. So this chart is color-coded by the top performers of the year, and at the bottom performers of the year. Now, there are a couple of things that we can learn from this chart. One is that there's no predictability for what next year's winners and losers are going to be. We can see that it's fairly random, and there's no leading indicators that would tell us that one market over the others, one market or one segment of the market is going to outperform another one. Going back to what I said earlier, nobody knows anything, okay? I mean, we have indications and guidance, but nobody knows anything. Today's top performers are rarely tomorrow's top performers. So that's the first thing that we learn from this. And the lesson to take away from that is that you pretty much need to own all of them in order to have a smooth ride. And so if we look at 2013 here, and I'll just go up here and circle it, this is something that we all already know, that stocks did very well in 2013, better than most people predicted that they would, okay? Down here at the bottom, we'll see that these assets, down here, commodities, emerging markets, bonds, cash, and to a degree real estate, did not perform as well this past year, okay? And what this chart shows us is a portfolio here that was allocated roughly, this is a portfolio that's roughly 70% equities and commodities and 30% bonds and other stuff, averaged about 14.9% for the year. And so if we look across this chart in the beginning, though, for a portfolio that's well diversified, what we see is the ride across the chart tends to be right across the middle and fairly smooth. And this is the inherent philosophy we try to bring to this process, which is nobody knows anything about tomorrow's top performers and bottom performers, and that's why you need to own them all. What you need to focus on is what a reasonable return for you to receive is over a period of time. And if you look far over here on the right-hand side of the chart, where you can see the 10-year annualized asset allocation return is 7.2%. So for somebody who owned a diversified portfolio over the last 10 years through thick and thin, including 2008, they've had an average annual return of around 7.2%. And so, again, this is the philosophy that we ascribe to, is that you need to be prudent about diversifying your assets across all these different asset classes. And so with that, I'm going to move on, but I wanted to remind the participants that if you have questions, simply submit the questions in the screen over on your right-hand side, and we'll be happy to answer them when we reach the conclusion. At this point, I'm going to turn it over to Chris Drawn and let Chris talk a little bit about looking forward.
All right. Good afternoon, everyone. Thanks for joining. Jeff covered many of the points that I'm going to reiterate at this point in the presentation, talking about factors that led to the positive results that we had for 2013. It's important to remember when we're looking at growth in the economy that over the last 50 years, economic growth, or GDP growth that Jeff defined, has averaged just over 3%. And so I think Jeff mentioned that 3% isn't great, but it's historically what we've experienced over the last 50 years. Now, granted, over the last decade, we've experienced less than 2. We think that we're on pace to do better than 3 in 2014. And there's one primary factor that contributes to that and a couple of variables that lead to it. The primary factor, in my opinion, is the level of confidence that the people that are in the economy have that contribute to the continued growth. And until that confidence changes, we'll see the economy continue to improve and move in the right direction. There are 5 variables that I think are going to continue to lead to that confidence. The first one Jeff and Ashley spoke of was consumption. Consumers are spending more. In 2012, your net worth, the value of your worth, assets minus liabilities, across all American households rose by $6 trillion in 2012, and it was up another $8 trillion in 2013. So that $14 trillion gain in net worth in yours and my and everyone else in America's pockets are leading to spending. I don't know if you've been to the St. John's Town Center recently or tried to come into St. Augustine on the weekend, but the streets are full. The second factor or variable that's going to continue to contribute, or begin to contribute in this case, is the rate that corporations, today's companies, are investing in their business. We spoke a little bit about the unemployment and the stubbornness of it coming down slowly, but it's interesting to note that nearly the entire number of jobs that were lost through the recession, which was, I believe, around a little over 8.5 million jobs, nearly all of those have been replaced. So this year, we're on track to having total employment exceed where we were at before the recession started. And that's a different way of looking at the employment situation in America. True, we have high unemployment, but we've had people coming into the labor market that have been replacing those jobs. And when those jobs get full, businesses begin to expand their operations. And it's that expansionary period when they go out and they add to their capital stock. They expand the factories. They buy more computers because they've got everybody back to work. I expect that to contribute to continued growth this year. Jeff and Ashley mentioned housing. We've seen housing prices begin to rebound and the level of inventory on the market begin to level off. But it hasn't been enough to keep pace with demand for housing. And so we've seen tremendous growth in new construction. And that's likely to continue. But what I think is more interesting is the level of affordability to own a home. interesting that if mortgage rates and home values were both to increase by 50%, housing would be as affordable as it was before the recession began in the early part of this decade. So we're well below what normally is considered affordable housing. So there's a lot of room for improvement in that area, and that significant level of affordability will continue to drive people buying houses and building houses. Fourthly is exports. Global manufacturing is at its highest level since February of 2011. So we've seen tremendous improvement in the level of manufacturing here in the U.S., actually touched on a little bit through the natural gas prices, contributing to making us more competitive on the world stage and helping us expand our manufacturing base. We've seen strides in Germany and in Britain and in Japan. But where we've also seen tremendous strides are in countries that were most hardest hit through the recession, like Greece. Remember that country? The one that was, I don't know, they were on the deep end. Italy and Ireland. Coincidentally, those are the fastest growing economies today in Europe. And so this synchronized expansion of global manufacturing will likely help the U.S. continue to grow economically as well. And then finally, the last variable, and Jeff touched on this, was government spending. We've seen tremendous progress made in reducing our annual deficit. And while we haven't enjoyed it, perhaps, the fact is we've brought our national deficit down from 10 trillion to about 4 trillion, and we're on track to reduce it by half over the next 2 years. Now, that doesn't mean that our debt has declined, but it shows that the rate that we're adding to our debt on an annual basis is slowing. There are no new taxes expected at the federal level, so that'll actually be a tailwind pushing the economy forward. Last year at this time we were talking about the sequester, and the media was getting us all anxious about the effects that would have on putting us back into a recession. And guess what? As usual, we made it through. And then finally, at the local level, we're starting to see states and local municipalities begin to spend more, and we believe that will help continued expansion here domestically. And those 5 factors together will help confidence remain high, and that'll be good for stocks. On the other hand, bonds aren't so good. And then this is where, in terms of outlook, I would remind us that the Federal Reserve has begun to taper the purchase of their bonds. But they've also committed themselves to keeping interest rates near zero through 2015. And so that means in the short term, going forward, things like CDs and money market accounts and short-term bonds and funds that invest in those will likely provide very little, if any, returns. As the economy improves, interest rates for longer-term bonds will be set by the market. And as the economy improves, interest rates will begin to rise on the long end. We saw that last year when interest rates on government bonds rose from about 1.5% to just under 3%. And that increase of about 1.5 percentage points resulted in the value of those bonds losing anywhere between 4 and 8%, depending upon when they were held. So I think going forward for bonds, we'll still have struggles as it relates to getting positive returns, which is the reason why we don't own long-term bonds in our portfolios, because of that specific risk. So internationally, there's a couple of things that I think are important. Again, Europe is in a much better shape than it was through the dark days of the recession. And that's really a result of the European central banks finally developing some leadership in mid-2011 and taking a page out of our Federal Reserve's playbook and committing to do whatever it takes to maintain unity in the European Union and inject liquidity into their banking system. And while that has been painful for many countries because they have imposed austerity measures and had to make some hard choices, and they've increased the balance sheets of those central banks so the threat of inflation is there. It was necessary, and it's working. We're seeing great things happen, like I said, in those countries that were hurt hardest. Their economies are beginning to rebound. Europe as a whole is beginning to come out of a recession, and they're poised today with cleaner balance sheets, much like the U.S. companies were coming out of our financial recession, to do good things. Jeff, do you have something to add there on the international outlook?
We've got a couple of questions that probably be good to address them while you're making some remarks on this. One of the questions is, with bonds not looking so good, how will a balanced portfolio take that into account with any rebalancing that's done?
Right. So you may have heard me throw in a little jab about our investment process, and that is that we're fully aware of the potential risk for bonds. Unlike stocks, the risk in bonds is somewhat quantifiable. We can do the math and determine that if rates go from 2% to 3%, what are the likely effects of my value of my bond? As a result, we've made the conscious decision some time ago to make sure that the bonds in our diversified portfolio are focused on those that have very short-term maturities. So we've exchanged the risk of losing value to move to something where we've got more of a stable value, even though it's not paying us anything. So when we construct portfolios, we're conscious to only focus on the bonds that are short-term in nature and are not likely to have the same level of interest rate risk in doing that portfolio. If you own a longer-term bond and you happen to have them in your portfolio, then what we would recommend is really evaluating the portfolio to find the right allocation for you and quantify that risk and move it into the right direction.
Right, and let me add something to that, Scott, or to Chris. If you look back at this chart, where we see that bonds have sometimes been contributors to returns, and like here and here, and other times they have been detractors, like this year. Okay, we look at bonds. The analogy I would give you is we view bonds as ballast in the ship. That we use short-term, high-quality fixed income instruments because they help keep the ship stable. Now, you may not like having ballast in your boat when the seas are calm and the sails are up and you're blowing and going. But when the storm clouds come on the horizon and the waves pick up, you're going to be really happy you've got some ballast in the bottom of your boat. And the chart, once again, illustrates that nobody knows what the future holds. We know the returns will be low on short-term, high-quality instruments, but they will be affected by interest rates. And with the Fed's commitment to keep interest rates low, we don't anticipate the fixed income position being a threat to the portfolio. The philosophies that we follow suggest that you should take risks where risks are worth taking. And that's with equities and other types of assets, not with bonds. You just don't get rewarded for taking risks in bonds. And so we've got another question here. I'm going to go ahead and let Chris go to.
Well, I was going to go over our derailers.
Sorry. Go back.
Yeah. So what could go wrong? I think domestically, there are two things that could occur to slow the economy down. The first one is a slowdown in corporate earnings. So corporate earnings have been growing at a pretty good clip, and in fact, we're at all-time record earnings if we were to look at the tape. But as we enter into earnings season, which happens every quarter, by the way, we'll get a sense to see how well are those earnings continuing to increase. So far this year, earnings season began last week, and each day a few companies report their earnings every day. And so far it's been a mixed bag. Some companies have have hit their earnings forecast out of the park, some have come in line, and some have missed horribly. And so we've seen a little bit of choppiness in the equity market as a result of that. And if, as a whole, earnings slow down from the pace that they were at, that could impact the stock market and cause it to back up. I think political risk is a factor that could influence the markets, although I think we're in less of a position for that to occur. We're in less of a crisis mode as we have been in the past. It appears, as Jeff said, that some of them are playing well together. You know, we passed a budget deal in December for the first time in a long time, I think it was.
Yeah.
But there are still some opportunities out there for them not to do well in the sandbox, and that could cause a concern. What I think is more likely to occur to the stock market, and not necessarily the economy, is that a normal correction will take place. Over time, historically, we've had a 10% pullback in the stock market once a year. But most of the time, the stock market ends higher than where it started in the beginning of the year. We didn't have a correction in 2013. So I'm of the opinion, or expectation rather, that a 10%, a normal correction is on the horizon. And when it occurs, it shouldn't be viewed as a time to get anxious and frustrated. It should be viewed as a normal, healthy process that takes place normally every year. And if we happen to have any cash on the sideline, which if you saw on the Skittles chart from before, returns absolutely zero, that would be the time to put it to work. In Europe, they're doing everything they can, they being the leadership in the European Union and the larger countries over there, to make sure that their economies perform and have a fundamentally sound base. As a result of that, they've had to go through austerity and implement different measures throughout. So my biggest fear is that as they enter their political season for sending representatives to the European Union, that a lot of the angst and frustration from internal groups will result in extremist political groups coming on the stage and trying to thwart the efforts that have been made of maintaining unity in Europe. But as Jeff mentioned, we don't know what's going to happen in the short term. So the way we handle these uncertainties is through diversification.
Okay. We have another question. I'll go ahead and answer this one before we move on to a couple of planning tips to close out here. This question references the fact that household debt service is down, meaning that people have more money to spend, yet the current administration continues to state that too many people, including the middle class, are in a precarious financial position. And the second question in the question is, how is the fact that the true unemployment numbers aren't reflected in what gets reported to us as unemployment? With the first question, it's particularly distressing to see this administration now turn, and I don't think it's coincidence, I think it's timed perfectly for the 2014 election, is effectively turn to what I would refer to as class baiting. And the income inequality is what you're hearing. That income inequality is becoming broader or wider and wider in this country. And the fact is that if you torture the numbers long enough, they'll admit to anything. You can make the numbers admit to anything. And so it is truly unfortunate that they're trying to focus on that. If I were in Congress today, in the House, I might be pointing to some of these numbers showing debt service is way down on a per household basis. Wages are up on a per household basis. And as Chris referred to earlier, the wealth effect. Over the last 2 years, people have seen their wealth increase dramatically on average, okay? So we don't discount that there are some people suffering in this economy still, and we don't discount that some of those people are less fortunate. But the idea that we're somehow going to take the American people's eye off of the ball by focusing them on the have and have not discussion rather than dealing with the issues at hand, largely out of control government spending. I think the people are too smart for that. I don't think that they're giving people enough credit. And in terms of the true unemployment numbers, you know, the hard fact is that some of the jobs that were lost in 08 and 09 are not coming back. Companies got lean and mean. They reduced their spending. They invested in technology to figure out how to do things with fewer people. And some of those jobs are not going to ever come back. Anybody who's had any construction work done on their home in this area in the last 6 months knows that, because a lot of those construction jobs went away and they have not come back. It's hard to find contractors these days. So, you know, the fact is that, you know, we're going to see expansion and the absorption of those jobs in other places like the energy sector. You know, the state of North Dakota has a negative unemployment rate. A negative unemployment rate. The highest grossing McDonald's on the planet is in Williston, North Dakota, where they have to pay $300 signing bonuses to hire people at McDonald's because people are making $100,000 driving oil trucks. So, you know, this is certainly not meant to be an explanation of how all of it's going to be okay. It's a structural issue, unemployment. It's going to take a long time to work its way out of the system. But some of these new jobs and new industries will absorb some of that. So with that, why don't we turn it back to Chris for some planning thoughts?
Okay. So whether it's for work or for vacation, or if you're trying to win a BCS national championship game, having a plan comes in handy. And so my first recommendation as we begin the new year is to make sure that your financial plan is updated. And if you don't have one, to give us a call so we can make sure that we've got it in place for you. You can do so much more when you have a plan. When looking at updating your plan, the things that you want to look at are what's changed in your life lately. What new things would you like to accomplish that you haven't yet done? And how will that affect the things that, the way you're going to go about doing it? You know, now's the perfect time to put that plan in place. So please, if you're out there and you don't have a plan, our responsibility as your advisors is to help you achieve those financial goals, and as a result, get that plan together with you. The next thing that we would encourage you to do is set appropriate expectations. And what I mean by setting appropriate expectations is specifically related to the returns that you earn in your portfolio. With the 30+% returns in the U.S. stock markets last year, we've already begun to see the greed factor coming in, if you will, and wanting more equity exposure in portfolios because we feel like we're missing the boat. Unfortunately, every time that happens, the market finds the time to do that correction that I mentioned a moment ago, and you know, we buy high and get upset when the market pulls back. So keeping an appropriate expectation in terms of what returns should be, I think is critical, and the start of the year is the right time to set those expectations. What we're thinking is appropriate for equities is somewhere between the 6 and 8% range over the next couple of years on average. Historically, the U.S. stock market has earned a little over 10%. We think where we're at in the business cycle and the gains that we've made coming out of our recession of 08, that a 6 to 8% range for the remainder of that cycle is reasonable. Fixed income assets, again, if you look at that Skittles chart, the long-term average was 4.5% for long-term bonds. I think that's not normal going forward. It's going to be difficult for long-term bonds to provide any positive return, and as a result, again, that's why we focus on short-term where we get the stability even though we know we're not getting compensated. So having reasonable expectations. And so a balanced portfolio for planning purposes, is going to yield somewhere around 6%. If we've got half of our money in something that's earning 8 and half of it that's not, we're probably going to come in somewhere around 4 or better. So, looking at it over the long term and setting appropriate expectations is our second recommendation this quarter.
And if I could just add something to that too, your returns are explained by what you own. That may sound like an oversimplification, but it's fact, right? Facts matter. Your returns are explained by what you own. If you own more of the stuff that is risk-oriented, then over time you should get better returns off of taking those risks. But at the same time, you need to focus on what you need to accomplish to achieve your objectives. So beating the stock market is not an objective. Living comfortably and outrunning inflation and taxes and dying before you run out of money, those are the issues you should be dealing with here. And so the question becomes, what's a fair return? What do I need to earn on an average annual basis on my investment portfolio to be able to sleep nights but also be able to eat well? And if that number is 6 to 8% a year, then you need to own a portfolio that historically would have delivered that 6 to 8% a year by owning the right mix of these various colors on the chart. So you can have whatever you want, you just have to accept the risk associated with it as well. And then you want to just cover this chart. I think this is an ideal chart. I put this in. I thought you folks would enjoy it.
Yeah, having a financial goals that lead to a plan that determine the investments that you use to create that plan are the keys. And then on an annual basis, you want to repeat and remix and repeat and remix and move forward. But it all begins with having goals, having a plan, and then putting a plan to work effectively with the right tools. And so as we move forward into 2014, I really want to emphasize the need to make sure you clearly know what you want to accomplish. The key that I think is making sure you don't run out of money before you run out of time. That's a big goal for everybody. And if you don't know what that number is, that's why we're here to help.
All right. Right before we wrap this up, we have one last question. Is the stock market overvalued?
Well, Chris may have a comment or two on that. I'll give you my 2 cents on it. Look, we believe markets are efficient. And what that means is that the prices, the values of a market reflect all known information at a given point in time, right? As well as expectations for the future. And so if markets are efficient, then markets are fairly priced. If you prefer a quantitative answer to the question, of the 17 measures that one of the large investment houses use, 14 of them show that the market is fairly valued to modestly overvalued, okay, but not a bubble. And I sense in the question there was the question of, is this a stock market bubble? As long as companies continue to earn money and increase their earnings, which has continued to be the case, then that obviously would support the valuation in the stock market. If this were the internet boom and companies that were losing money were tripling their share price every day, I would tell you I would be concerned about that. But when Goldman Sachs comes out and is supposed to earn $4.20 a share and they earn $4.65, that warms my heart. And so, we try to look at the basic fundamentals here to determine whether things are undervalued or overvalued, and we believe that markets are efficient, so the markets are reflecting the true perceived value. And for those of you who saw our newsletter at the beginning of the month, you'll know that Gene Fama got awarded the Nobel Prize in October for his efficient market theory, right, which is the basis of all the planning that we do. And just to toot that horn just for a second, that brings to 4 the number of Nobel Prize winners that are affiliated with our partners that we manage money through. That's 4. I don't know of any other financial organization where they can claim they have 4 Nobel Prize winners as research scientists on their staff. So again, for us, it's just validation that this approach that the markets are efficient and the markets reflect all known information at any given time is a relevant point.
Yeah. The only thing that I would add to that, and I think it's baked into the question, is the value at which the stock market is reported on a day-to-day basis, whether it's the Dow Jones Industrial or the S&P 500. You know, when we turn on the TV, the media tells us whatever that number happens to be. We have to put that number into context. The number by itself is just a number, but when we measure that against something is when we can answer the question, is it overvalued or not? And Jeff alluded to the fact that for many of the ways in which you measure the value of a company, they're all pointing that the market as a whole is generally fairly valued at this point. And what I would say is that coming out of the recession, with all of the headwind that we had with the government and the economy and unemployment and all of the crises that we went through, it kept the share prices suppressed, while earnings, that the economy showed some life. I think the media began to take their focus off of how, trying to tell us how bad the world is, and as a result got out of the way, and share prices caught up to where they should have been, which is having them be fairly valued at this point.
Yeah, and just I'll say one more thing, and then we'll conclude the webinar for today. But we would, in order to exercise good behavior, we would encourage investors to think like business owners, not a renter. Okay, most business people don't get up in the morning and ask whether they should sell their business that day. If they own a pizza shop, they don't think about whether they really should own a shoe store instead. You know, they show patience and they're persistent, and they try to understand their underlying business better so they can earn the greatest return for the longest period of time. So to a degree, if you watch the day-to-day machinations of the market or CNBC or Fox News, my first piece of advice is you need to stop doing that because it's not helping you at all. And people get misled by the volatility day to day. The values of underlying businesses and companies just don't change as quickly as the stock prices do. That's just a fact. And you know, you don't really have to be a hawk and watch it day in and day out. So again, that would be my parting advice. And with that, I'll turn it over to Ashley to close it out.
Once again, we want to thank you for joining us for our first drive-through review of the year. Our next review is going to be April 10th at 4. And feel free to forward the invitation once you get it to any family, friends, or colleagues. A replay of this webinar is going to be on our website at firstcoastadvisors.com, and you can go ahead and forward that as well.
With that, thank you, panelists. Appreciate you being here, and we'll look forward to speaking to you all on April 10th.